And we are live, everyone. Good evening. Larry Pershing here, founder of Optimum Retirement Planning. I am a certified financial planner. And tonight we're going to be talking about Roth conversions, the basics here, 101. I chose this topic tonight because I hadn't talked about it in like 4 or 5 months. And the group has grown by, I think, like 1,500 people, maybe even 2,000 since the last time I had this presentation. So I thought, hey, roughly half the Facebook group hasn't seen this. So it might be interesting for people to see it, get the basics down. And also for the first time ever, I'm also streaming this live on YouTube as well. So let me quickly make sure that both of those are working, and then we'll get on with the presentation in 2 seconds here. Okay, so I see Facebook is good. And now what about YouTube? The new one. It looks like YouTube is good. Well, actually, I don't know. I'm still getting YouTube down, guys. If you haven't heard, I've got a YouTube channel here, which I could actually show you guys, but I'm really excited about it. I'm going to be doing shorter content in the YouTube channel, still keeping the longer, hour-long live streams here. Shorter YouTube channel stuff here. Okay, great. And so now I can see YouTube. So we've got both these things going. Let's get the presentation started. Hey, everyone. How you doing? Thanks so much for joining me. And yeah, thanks so much for congratulating me on the YouTube channel. I'm really excited about it because I know a lot of people are like, hey, Larry, I like what your content, but it's just too long for me. Or I've got a lot of feedback too that YouTube's actually easier for people, which I was a little surprised about. But I guess it makes sense. So definitely going to be putting a lot more content on YouTube, but still keeping the live streams going here. So don't worry, live streams are not going away. So, okay, Roth conversions, uno. Of course, before getting into this, we have got quick disclaimer. All the information here is educational nature. None of the content today is specific tax, legal, or investment advice for your situation. It is not that. So please, before taking any action for your situation, always speak with your tax, legal, or investment professional. All right, we got that out of the way. So what the heck is a Roth conversion? Well, all a Roth conversion is when you take money from a traditional IRA and you move it over into a Roth IRA. The government allows you to do this, okay? Anybody can do this as long as you have money in a traditional IRA. But the catch is that any money you move from a traditional IRA into a Roth IRA, you have to pay taxes on the full amount. Now, the one major exception to that is if you have after-tax money in your traditional IRA. We'll touch upon that a little bit later, but for our sake here, we're all talking about pre-tax money here in this traditional IRA. So you've got to pay taxes on the money you move from a traditional IRA to a Roth IRA. Well, excuse me, why would you want to do that? Why would you want to go ahead and accelerate taxes? Well, it's because any money in a Roth IRA, any growth on any money you get into a Roth IRA, I should say the growth on money you get into a Roth IRA is tax-free if you follow the Roth IRA withdrawal rules, which we'll touch upon here in a second. But as long as you follow those Roth IRA withdrawal rules, you're going to get all the money in your Roth IRA, all the growth that comes from that, tax-free. So now it kind of just becomes a decision of like, hey, I have to pay the taxes up front, but if I do that, then I get tax-free growth. So we're going to talk about like how you deal with this trade-off here. And really the whole idea behind dealing with the trade-off of Roth conversions is just to say, okay, again, we move money from a traditional IRA to a Roth IRA, we have to pay taxes on that, right? Well, so that we have to pay taxes up front. So either means we can't get the full amount of money into the Roth IRA, or we have to use some outside money to pay the taxes. So in this example here, we've got $10,000 in the traditional IRA. We move the full amount to the Roth IRA. We're going to owe taxes on this $10,000. And that means we're going to have to take money from outside our retirement accounts to pay for it. Now, of course, this could just be like another retirement account outside, but somewhere, somehow, you are basically reducing your net worth, right? You're reducing the amount of money you have because you're paying the taxes up front. Okay, so whether it's in your retirement accounts or somewhere else, the taxes have got to come from somewhere to pay for the Roth conversions. So you have less money now after you've paid the Roth conversion, but you get the tax-free growth. So you kind of have to balance the opportunity cost of paying those taxes up front, because remember, when you pay the taxes up front, you now have less money overall. And that less money, you could have, you now have less money to grow, to produce interest and dividends for income purposes, or just investment growth. So you're going to have, all things else being equal, lower investment growth, lower income from your investments by doing a Roth conversion. But then on the flip side, you're going to get tax-free growth. So that's the tension in Roth conversion and the trade-off. And if you do it right, then if you do a Roth conversion correctly, then the tax-free growth benefit is going to outweigh, it's going to give you much more tax savings than the opportunity cost of having less money to grow for you in the future. But if you do a Roth conversion incorrectly, then the opportunity cost of paying the taxes up front is going to be so great that it's going to be larger and negate the tax-free benefits, the tax-free growth you get from money in a Roth IRA. So you got to balance the two. We'll talk more about that, but that's in a nutshell what's going on with the Roth conversion. So you want to do Roth conversions because they can reduce your taxes if done correctly. A common misconception I hear is that, oh, hey, Roth conversions, it's kind of like an an investment strategy. Like, I'm going to compare Roth conversions versus increasing my stock allocation. And no, that's not an apples to apples comparison. It's going to lead to some faulty analysis and faulty assumptions. One, you can have an investment strategy and do a Roth conversion. It's not like a binary choice. You can do both. Think of like a Venn diagram here. It's not like Roth conversions and a Roth conversion and investment strategy. There's a Venn diagram. You can do both. Sort of thing. Now the analysis does get a little interesting when you want to pay for the taxes for Roth conversions with outside retirement accounts. And you say, hey, maybe you have $20,000 in your bank account. And you're like, well, if I do a Roth conversion, I can use that $20,000 to pay the taxes for the Roth conversion and get more money into my Roth IRA. Or I can use that $20,000 to pay down my mortgage, for example. That is an interesting question. And that's where it gets a little gray. But we're not going to cover that specific question there. But ideally, just remember that Roth conversions are primarily a tax strategy. Okay, they're not, even though you're making moves with your investments, it's not like you're really changing your overall investment strategy. And Roth conversions shouldn't change your investment strategy, in my opinion. The vast majority of the time. The one time where Roth conversions can be good for changing your investment strategy, and again, this is where we're kind of at the intersection of investments and taxes here, more so, is your asset location. Asset location is different from asset allocation. Asset allocation is essentially, hey, how do I divvy up my investments? If you think of a pie chart, how do I be diversified and how much money do I invest in stocks, bonds, cash, etc. That's your asset allocation. Asset location is the idea of your investments are taxed differently based on which account type they're in. So investments are taxed based on the type of investment you have and the type of account they're in. So essentially, you just want to pair those two together, all your investments with their account types. You want to pair them together, and that will reduce your taxes overall. You want to just pair the tax characteristics to reduce your taxes overall. So you can kind of think about that like you're having a nice dinner. Maybe you cook some steak. And, I'd say most people say, hey, if you're having steak, you should have some red wine with your steak. But if you cook a nice, like, light fish, you may want to have white wine with that, especially if it's the summer, you're outside. Some nice white wine there. A lot of people would say, hey, the white wine and the fish on a summer evening goes better than white wine with a steak. The steak and the red wine kind of enhance the whole meal, right? Because there's some synergies there between them. That's essentially what asset allocation is. But for taxes of, hey, for example, stocks, high growth asset, we want to keep those in the Roth IRA. So going back to Roth conversions, Roth conversion gets money in your Roth IRA. Well, overall, you still want to have 50% stock, 50% bonds. Let's say that's your asset allocation. But looking at all of your investment accounts overall, you still want to keep 50% stocks, 50% bonds. But now when we zoom in on your Roth IRA account, you want to have 100% stocks in there. You don't want to have any bonds in there unless you think those are really high growth bonds. But I'd say for this example, let's keep it simple. You tend to want to have your highest growth assets in your Roth IRA because that maximizes the benefits of the Roth IRA, which is tax-free growth. So if you have, a 50-50 split between stocks and bonds in your Roth IRA, you're not maximizing the benefits of a Roth IRA. Now, again, I am not telling you, hey, change your asset allocation, your investment strategy to get all stocks in your Roth IRA. If you have a huge Roth IRA relative to other accounts, you may not be able to have 100% stocks in that, and that's okay because investment strategy much, much, much more important than asset location. Like investment strategy is like number one importance, and asset location, is way down here. It's not even close how much more important they are. So let's see. I think that pretty much covers why do a Roth conversion. Oh, and I guess Roth conversions can also reduce your state estate taxes. So not federal income taxes. Federal income taxes, they give you a credit. Essentially, guys, remember that with your pre-tax IRAs, someone's got to pay taxes on that eventually, where it's you, your beneficiary. When the money comes out, somebody's got to pay taxes on it. I guess unless you give it to a charity or something like that. But for a real living person receiving a pre-tax IRA, when they pull the money out, they got to pay the taxes on it. And the government recognized that, hey, if we force you to pay estate taxes on the value of a pre-tax IRA, then that's a little unfair because we know that's not the true value because we're gonna make you pay taxes on it. So your estate taxes, you'd be getting kind of double tax on your estate taxes. You have to pay estate tax on your IRA amount, even though your IRA is also going to be taxed. So the federal government has like a little thing to work around that. But, state tax exemption is like, what is it nowadays? Like $13 million a person, maybe 11. I don't know. For a married couple, it's over 20 million. I think it's 13 million per person now, somewhere around there. So it's big. Most people don't deal with that, but state to state taxes can be a lot lower. Example, my home state, I'm from Chicago, or live in Chicago. I'm from Los Angeles, live in Chicago, live in the great state of Illinois, and the Illinois state tax is $4 million, $4 million exemption. So if your net worth is below 4 million, you're good. If it's over 4 million, not so good. You're going to get hit with Illinois state estate tax. And Roth conversions, remember Roth conversions reduce the amount of money you have. So it reduces that figure and can help you reduce the state estate taxes. But those aren't as popular. Those have really gone away, especially back in, I think it was 21 when the federal government tweaked the estate tax rules. Okay. Yep. So why do a Roth conversion? Why not do a Roth conversion? Well, if you do a Roth conversion incorrectly, you can increase your lifetime tax burden. So there are risks to Roth conversions. I think my biggest pet peeve is that people position, and I'm a big Roth conversion guy. I mean, I help a lot of clients with it. It's beneficial for many people, but for many people, it's also not beneficial. It really is a case by case scenario. I have a big pet peeve where people go, yeah, look at how wonderful Roth conversions are. Everybody should be doing a Roth conversion. No, that's absolutely not right. I run into it like fairly commonly enough where I'm not surprised where it happens, where I'm like, you don't need to be doing a Roth conversion. Like maybe in the future, potentially, maybe a couple years down the road or something. This is even for retirees. I'm talking about Roth conversions cannot be beneficial. And again, it becomes that trade-off of the opportunity cost. Remember, your Roth conversions reduce the amount of money you have because you're accelerating taxes. You're paying taxes up front. So that money you pay the taxes to, you can't use to grow or produce income for you. There's that opportunity cost, that money. And you have to balance that with the tax-free growth. And if you don't balance it right, then Roth conversions can harm you. So there's some risk there. And that's maybe one reason why the government lets us all do this, is that the government says, hey, are you really going to guess right? You kind of have to predict the future a little bit. So there's that, but also really why the federal government, my opinion, this is opinion, why the federal government likes Roth conversion so much. The federal government scores most legislation, Congress, when they're passing legislation, the budget office scores legislation on a 10-year time frame, most of it. And Roth conversions can look really good on a 10-year time frame for the government because it's taxes coming in up front. It's a bunch of taxes coming in up front. So they're like, oh, this is fantastic, And so taking away Roth conversions might not look so good on the 10-year time frame. It probably is going to look a lot better for the federal government on a 20, 30-year time frame. But that the federal government might not be able to see that far in advance with tax legislation. Okay, back to the subject at hand. Sorry about that diversion. So again, we're talking about this trade-off here with Roth conversions. And again, they can be harmful. There's a risk that if you don't do them correctly, they will increase your lifetime tax burden or otherwise, in other words, reduce your after-tax wealth, which is the whole game here, right? Roth conversions are, when we say they reduce your taxes, that's great. But why do we care? Because really reducing your taxes means there's more money for me left over at the end of the day. It increases your after-tax wealth. Well, what makes Roth conversion so tricky and why it's so case-by-case basis is because there's a bunch of stealth taxes in the tax code. And here's what I mean by this. I think most people have heard about the tax brackets, right? They understand that, hey, that we have a progressive income tax system. So we start at the 10% bracket, then we go to the 12%, 22, 24, 32, etc. And, so the more money I make, the higher tax rate I have to pay. That we all understand that. But then there's also parts of the tax code that don't show up in these tax brackets that can increase your taxes during anywhere in these brackets. And so just for some examples here, IRMA is a big one. That's the Medicare premium for Part B and Part D adjustment based on income. So if you go $1 over these income limits and they're not lined up with the tax brackets, you could increase your Medicare premiums by hundreds to thousands of dollars a year. Now, IRMA is rolling every year. It kind of is based on your income. Well, your income from 2 years ago every year. So it resets every year. Don't if this is your first time hearing this, don't worry. This isn't gonna doom you forever if you have high income 1 year. But these IRMA premiums, you go $1 over these limits, increases your Medicare premiums by a couple hundred, a couple $1,000s a year. That's essentially a tax on income. And again, it doesn't show up in the tax brackets. We can't see that, but it's there. The same thing with capital gains. If you have capital gains in the 0% tax bracket, a lot of talk about this. Hey, pay zero taxes in retirement. All great. Love it. Help people do that. But if you also try and combine that with a Roth conversion strategy, you may find that your Roth conversion income pushes you into a high enough income level where all of a sudden those capital gains go from 0% taxation to 15% taxation. Plus your Roth conversions getting taxed. So it's actually a double tax. It's no fun. It's no good. Roth conversions can increase the taxation of your Social Security. They can cause you to lose deductions like, I think a big one is the medical itemized expense deduction. So increases your AGI and then you can't, you don't have as big of a deduction if you had high medical expenses for a year. And on and on and on. I could go on for a while on this. And there's more. ACA premiums is another one. If you get the ACA premium tax subsidy to help reduce your health insurance costs before age 65, Roth conversions can really screw that up. So that's all the reason not to. I think I'm beating the dead horse. Oh, I got a question here. Any sense what percent? If you could give me a little bit more background on what you're talking about, that would be really nice. Sorry, I wasn't quite paying attention where you're going. And that also reminds me, I think you answered. Let me just quickly check in on YouTube here and see if we've got anyone in the chat here. Nope. Okay, great. Okay. They redid their question. So, any sense what percent of population even have Roths, let alone what percent of retirees actually do Roth conversions? I have a sense these conversions became popular with older folks who have large TRAD, which is traditional IRAs, before Roths were available. It's a great question. And honestly, I don't know. I'm trying to think. There's got to be some data out there on what percentage have Roths. Now, what percentage of retirees are doing Roth conversions? I don't know if that data is available because the IRS is the only one who knows. And I mean, they could release anonymized tax return data, but I mean, yeah, I'm sure maybe even that's out there. I wonder if anybody, any IRS, sleuths or super fans would know the answer to these questions. But you're absolutely right that they become really popular with retirees. People, I like to joke around, age 55 or better. And Roth conversions, we're going to talk about, big opportunity in your tax valley, basically in your low income years after you've retired, before Social Security RMDs have hit in. That's where Roth conversions are generally most beneficial for people and where they become popularity. But what really supercharged Roth conversions popularity, is actually two things in my opinion. One, I may actually even say three things. But one is the 2017 tax cuts legislation that cut tax rates. Tax rates are pretty low right now, and you've got a lot of room in them. It hasn't always been that way in the past. So this has kind of like expanded the opportunity for Roth conversions. And we know that based on the tax code as it is written today, of course, it can always be changed, but as it's written today, taxes are going to revert back to the higher pre-2017 rates in 2026. So again, in 2026, tax rates are going up. That's written to the tax code today. It can always be changed, which we're going to talk about. But so because of that, a lot of people are like, well, I mean, probably good chance taxes are going to go up in a couple of years. So that's going to be really fertile ground for Roth conversions. We're going to talk about that more. And a second reason is just that my profession, financial advisors, has, in my opinion, gotten way better over the past 15 years. Certified financial planner designation has really taken off. And frankly, there's just been a lot more competition in the industry. And so advisors have had to up their game. And then thirdly, the internet has allowed ideas like this to spread much more quickly than it has before. So I think all those three things have really boosted the popularity of Roth conversions. Diabolical phantom taxes and phase outs. Yeah, absolutely. The tax code, incredibly complex. Oh, David, of course, David knows, my man. According to Fidelity, only 10% of people do Roth conversions. And that kind of jives with me because, one, most people just don't care. Two, I think the median American has around like $250,000 saved for retirement. And the average American takes Social Security pretty early. So if you don't have that much of assets and you're getting Social Security in Roth conversions, got Social Security to be taxed, might not be a great situation for people. Like I feel like low income people, Roth conversions can be really tricky for, more than like medium or high income retirees. Think like people, if you want to spend $60,000 and up in retirement, usually that's like the sweet spot for Roth conversions. But if you're spending under 60 and you have Social Security benefits, I find that Roth conversions get tough. And again, Roth conversions benefit richer people, just frankly. I mean, that's why financial advisors love to talk about it, because people with larger account sizes are going to benefit a lot more from Roth conversions because they've got more dollars and they're going to have more RMDs later on in retirement. So, okay, let's, thanks for that, David. If you, I don't know, maybe we'll have to get the link out to that for the people somehow. Or if you could post the link, that would be great in the chat. I'd appreciate it. So let's see. Okay, so Roth conversion limits, you're really only limited for Roth conversions to the amount of money you have in pre-tax accounts, your 401ks, pre-tax traditional IRAs, things of that nature. You cannot do Roth conversions in inherited IRA accounts though. And also too, your 401k provider doesn't necessarily need to allow you to do in-plan Roth conversions. You may need to wait until you roll that into an IRA to be allowed to do a Roth conversion. And this is really important. If you have required minimum distributions for the year, RMDs, that's the rule the government says, hey, you have to start taking money out of your pre-tax IRAs. You need to take enough money out of your IRA first to fulfill that requirement. And then you can do a Roth conversion with money above that. So if your RMD, for example, is $10,000 a year, you have to take $10,000 out of your IRA. It cannot be a Roth conversion. You just have to pay the taxes on the money and take it out of your retirement accounts. And then after you've taken that $10,000 out, then you could do another, 10,000, 20, whatever, however much your account value is. You can potentially do that with a Roth conversion. Not saying I recommend that almost always, unless your account's really small. Do you want to convert your whole account? You want to do this over several years generally, and you generally don't want to convert all of your account to begin with. There's no income limits, no age limits, no dollar limits for Roth conversions as of today, August 29th, 2023. Could change though. Congress should always change. They were talking about in the tax legislation to put income limits on Roth conversions. We'll just have to see. Okay, so taxation of Roth conversions. Again, when you move money from a pre-tax IRA to a Roth IRA, you have to pay taxes on it. That's going to depend on your tax rate. Then we have to think about all of these stealth taxes with it, which gets real fun. But one really critical piece or point I want to make is that if you do a Roth conversion, you're underage, the early withdrawal penalty exemption. So if you're I should back up. If you're underage 59 and a half and you take money out of your pre-tax IRA account, you have to pay taxes on the money and you get hit with a 10% early withdrawal penalty. So if you don't have an exemption to that 10% early withdrawal penalty, then you do a Roth conversion. Let's say you're 58 years old. You want to do a $10,000 Roth conversion. So that's $10,000 that you're taxed on, and you try and withhold some of that for the IRS. You try and split that $10,000 and send $8,000 into your Roth IRA and $2,000 to pay the taxes. The $8,000 that goes in your Roth IRA, that's exempt from the early withdrawal penalty. Roth conversions are one of the exemptions. It's like a special rule with them where you don't get hit with the 10% early withdrawal penalty if you do a Roth conversion. But any money you withhold for taxes or that you take out of your IRA to pay the taxes on Roth conversions from your IRA, that is going to get taxed and get hit with the 10% early withdrawal penalty. So basically, if you're under age 59 and a half and you want to do a Roth conversion, make sure you have money outside of a retirement account to pay the Roth conversion with. And if you're under age 59 and a half, be really careful about the Roth IRA withdrawal rules because they can get tricky, especially with Roth conversions. All right. Let's see. Taxes. Yeah. Generally, it is favorable to pay the taxes for Roth conversions with outside funds, with non-retirement account money. So think taxable accounts, bank accounts, something like that. It boosts the benefits of Roth conversions. But again, if you don't do the Roth conversion correctly up front, you can still, even with paying the taxes with outside accounts, still screw up, and the Roth conversion can increase your lifetime tax burden, reduce your after-tax wealth, even if you pay taxes with outside money. So first, make sure you're doing the Roth conversion right. And then after that, then say, okay, how should I pay for the taxes? Well, it's best to do it with an outside account in the vast majority of situations. If you do have after-tax money in your pre-tax IRAs, it gets really complicated. It's going to be subject to the IRA pro rata rule, which basically means, hey, whatever percentage of pre-tax and after-tax money you have in your IRA, that's going to be part of the Roth conversion. So if 1% of your money is after-tax money, then 1% of the Roth conversion amount will be after-tax money, and you won't be taxed on it. You'll only be taxed on 99% of the Roth conversion amount. This rule also trips up people because it aggregates all of your IRAs, even the IRAs that you aren't doing the Roth conversion from. So you do Roth conversion from IRA A into Roth IRA A, and IRA C over here. For the pro rata rule, you still have to combine them together. You can get around the pro rata rule by sending money into a 401k, and you can even send just pre-tax money into a 401k and leave after-tax money in your IRA accounts and let you do a tax-free Roth conversion. Oh man, we got a ton of comments here. What's going on, guys? Let's see what's going on. Given the budget deficit, yeah, I think they're referring to, hey, taxes could go up because U.S. is running a budget deficit. We've got some debt, and so taxes may have to be raised in the future. Valid point. do you have to pay tax out of a retirement account? So it depends on the retirement account, and it depends on if you follow the withdrawal rules. So two basic types of retirement accounts, pre-tax accounts, which is 401ks, 403bs, pre-tax IRAs, traditional IRAs. Those, when you pull money out, you have to pay your ordinary income taxes on it. It's just taxable income that's going to be determined by your tax situation. And that's primarily going to be, your other sources of income and what's going on in your life that year. And then also to your age, you want to make sure that if you're over age 59 and a half, or if you are over age 59 and a half, you don't get hit with the 10% early withdrawal penalty on withdrawing money from your IRAs. If you're under age 59 and a half, you got to be careful about that. But again, so pre-tax IRAs, you have to pay taxes when you pull money, or pre-tax accounts, I should say, 401ks, 403bs, IRAs, etc. If you put the money in pre-tax, when it comes out, it's going to be taxable. If you have a Roth IRA and you pull money out of a Roth IRA, as long as you follow the withdrawal rules, which we'll talk about in a second, then you'll get that tax-free. So I hope that answers the question, Debbie. Appreciate it. It's a good question. And I think I see what you're saying now. Do you have to pay tax out of a retirement account? No. So you withdraw money. You have to pay the taxes, but it doesn't mean. So for example, let's say you want to take $10,000 out of your retirement account. Well, there's two ways to do that. You can gross it up depending on your income tax rate. If your income tax rate is 10%, then let's see, and you want $10,000 net after taxes, you'll need to take out $11,000. $111.11, because all that's going to be taxed at 10%. And so the net of $11,111 is going to be $10,000. Or you can just take the $10,000 out of your IRA and you have cash in your bank account. You can just send that to the IRS for the taxes on the money. So you don't have to withhold money from your IRA at the source, although it can be beneficial for tax purposes. Well, one, it's just easy. You've done it. You can check that off your list. You don't have to remember to go, oh, hey, I got to go pay the IRS, make an estimated tax payment. And two, estimated tax payments can get complicated. There's also some other benefits to withholding money. It can the IRS will sometimes say, hey, we'll just assume you withheld this throughout the year, which can be helpful. So it's more complicated. But yeah, absolutely. You can pay the tax. You can pay the tax due on money taken out of a retirement account with other sources. It doesn't have to be from the retirement account. Great points. These numbers don't favor Roth conversions. Also, it's been beaten to everyone that delaying taxes is good. Do a conversion, pay taxes now. What? Are you nuts? This is where a lot of heads are at. Yes. And it's a really great point that, your whole life you're taught, put money into pre-tax accounts. There's benefits to tax deferral, which tax deferral is not avoiding taxes. It's just delaying paying taxes because, hey, if you delay paying taxes, you can use that money that you would have paid to taxes you keep yourself to help you grow your money more. For example, you owe the government $100,000. The government says, pay me that $100,000 in 10 years. Well, okay, sweet. That means you can use that $100,000, and invest in a 10-year U.S. Treasury earning 4% per year. And, you're not going to double your money, but you're probably going to get you're going to get close to $50,000 from it over 10 years. So that's $50,000 extra dollars you wouldn't have if you had to pay the government that $100,000 up front. So that's the benefit of tax delaying it. But Roth conversions are an exception to this. I'm going to show you the math on why that is. But yeah, it's one of those funny things where Roth conversions can be, and again, as long as they're done correctly, they can be that exception to the rule where delay. Roth conversions can be the exception where it makes sense to actually accelerate your tax payments. And we'll talk about why in a second. Given the budget deficits, any chance that these Roths will somehow become taxable? Okay, real quick so the question is, hey, if you're concerned about how much debt the U.S. government has and that, the government right now is spending a lot more than it's taking in, the government may need to raise taxes in the future. Could they tax Roth IRAs? I mean, I could like I'm not a constitutional taxation expert. I don't know. I think it's probably unlikely though, because explicitly the government says, hey, you pay taxes once, we're going to give it to you tax free. I think definitely the government will not be able to tax your contributions. Whether they can tax the tax free earnings is another question. I highly doubt it, though, because that's going to upset a lot of people. One, and two, the government basically said, here's the deal, and pulling the rug out from underneath people is going to make them really upset, and probably it's definitely going to be challenged in court. Whether it holds up or not, I couldn't tell you. But I think what a much more likely scenario with Roth conversions is it gets included in stealth taxes. So, for example, municipal bond income. Municipal bonds are state and local bonds. And essentially the deal with that is that the federal government cannot tax income from municipal bonds. But what the federal government has done is said, okay, I'm not going to tax it. I'm not going to, say, hey, this income is included for tax purposes. But what I will do is I'll include in all these little stealth taxes. I'll include that income, which if you have this income, then you get this stealth tax. So for example, IRMA, your Medicare premiums, if you go $1 over certain limits, your Medicare premiums jump hundreds of thousands of dollars a year. This is Medicare Part B and D. And municipal bond interest income is included in the income calculation for IRMA for the Medicare premium. So municipal bond interest can push you over that municipal bond interest income, even though it's not taxable at the federal level, can push you over that limit. And then your Medicare premiums increase, which is a de facto tax. I think they can do a lot of sneaky things like that for Roth conversions, like put it in the IRMA calculations or in the ACA premium tax credit calculations or Social Security taxation. I mean, there's a whole bunch of stuff where I think that's where they might be able to like finagle their way around it and get Roth IRA income taxed. SS will increase from 85 to 199%. I think that's referring to the taxation of Social Security benefits. It would be interesting if Social Security benefits were taxed at 200%. I don't know about that one. Thank you, David. So here's the link from Bard discussing the Fidelity study. So I guess you go on Bard, Google, that's Google's like ChatGPT thing. And if I'm sure you type in that Fidelity Roth, how many people have Roth IRAs, it'll come up. So okay, I love this comment here. You'll let your balance double or triple, then be okay paying higher post-26 tax rates on the much larger amount of distribution. All that growth can be tax-free in the Roth. I think this is one of the biggest misconceptions with Roth IRAs. We're about to get in the math behind them, and I think, once we do this, it's going to make sense why this is not the correct way to think about Roth conversions. What matters on Roth conversions is the tax rates you pay today versus the tax rates you pay in the future. If you pay higher tax rates today, it doesn't matter how much your money grows in the future. It's going to increase your lifetime tax burden or reduce your after-tax wealth. If you pay lower taxes today than you would have been subject to in the future, then the Roth conversion will be beneficial, will reduce your lifetime tax burden and increase your after-tax wealth. Because remember, just because you have a bunch of growth, you get money into you do a Roth conversion, get money into a Roth IRA. Just because you have a lot of growth in the future that's tax-free, remember, you had to pay taxes to get that money into the Roth IRA to get the tax-free growth. So presumably, if you had used the same investment strategy that gets you all this growth in your Roth IRA, if you had kept it in your IRA, you would have had a bunch more money too. And potentially, even though you had to pay taxes on it, you got to keep that money earning for you for a longer period of time, and you would have had more money after paying the taxes. So we're going to see how to balance that in a second, but it's a really good comment. I really appreciate you sharing that, because that kind of thinking really trips people up. So great addition to the conversation. So taxation of Roth conversion. So just this really simple example. Yeah. Hey, do a $10,000 Roth conversion, start out with $10,000 in your traditional IRA. and you put $8,000 in the Roth IRA, and then you can put $2,000 to the IRS. Remember, this is good if you're over age 59 and a half. If you're under, not so good. Just, do an $8,000 Roth conversion and pay less taxes with outside money, or do the full amount to the Roth IRA and pay the taxes with outside money again if you're under age 59 and a half. Also, let me check on YouTube real quick to make sure there's no questions on that. Yep. Okay. No questions. I don't know. Nobody knows. Nobody knows I'm on YouTube yet. So probably that's why. So, okay. How Roth conversion money is taxed upon withdrawal. The simple way, because I want to get into when to do a Roth conversion, because I got a lot of questions on that. What you should know about gosh, that's really, really sensitive. What you should know about Roth IRA withdrawal rules is that if you're over age 59 and a half and you have open and funded any Roth IRA for 5 years, all of your Roth IRAs, you can pull the money out tax-free. It's that simple. Again, if you're over age 59 and a half and you have open and funded a Roth IRA, any one Roth IRA for 5 years, then you can take all the money out of your Roth IRA tax-free. Don't have to worry about, whether it's Roth IRA contributions, Roth conversions, etc. If you don't meet one of these two qualifications, then you can't pull the investment growth in your Roth IRA money out tax-free. So the investment growth cannot come out tax-free. Roth conversion principal, you either have to wait 5 calendar years from when you did the Roth conversion. Roth conversion principal is the original amount. So you did a $10,000 Roth conversion. You took $10,000 from your traditional IRA, put into your Roth IRA. You either need to wait 5 calendar years in order to be able to pull that out, or you have to be over age 59 and a half, either of them, then you can pull it out. You can pull it out tax-free, but you'll get hit with that 10. And if you don't follow these rules and you pull out that principal, then you'll be hit with the 10% early withdrawal tax. And again, there's an ordering rule to the Roth IRA withdrawals, because we're talking about, there's Roth IRA contributions, there's Roth conversion principal amounts, and then there's investment growth. And basically the withdrawal rules work where it always works where you're going to have to take out the most beneficial amount to you. So the Roth IRA withdrawal rules are really nice in that they work in your favor. The type of money you take out, it's generally going to be the most beneficial to you from a tax perspective. It's going to be the one that you have to pay the least amount of taxes on or tax penalties on. So let's see here. That's basically it for Roth conversion money. So I really want to get into when to do a Roth conversion. Okay, so the best environment for Roth conversions is when you pay a lower marginal tax rate today versus higher marginal tax rates in the future. That's the sweet spot for Roth conversions. We're going to talk about why we care about marginal tax rates in a second, but just know that. And for those of you who are like, what the heck are you talking about, Larry? I like to call it the tax valley. You see this little valley here. Most people's tax rates in retirement, or you can even think about it as taxation too, as just normal taxation or tax rates. Towards the end of your career, you're earning good money, you're paying a decent amount of taxes, your tax rates are high, and then you retire and you get into the valley here. Notice you go down, right? The valley is a lot lower than the sides of the valley. So on the bottom floor of the valley here, this is when you're in your low tax years of retirement, the first couple of years of your retirement. You maybe haven't started taking Social Security yet. You don't have required minimum distributions yet. Generally, your income's a little bit lower during these years. Though it does depend on your spending. And so this is where Roth conversions can potentially be beneficial and are usually when they're the most beneficial for people, if they are beneficial to begin with. And of course, once we start to climb up out of the valley here, that's later on in retirement. Think when you've started to begin Social Security and you have that required minimum distribution income that lifts up your income, and now you're paying a lot of taxes, you're at your high income levels again. So you don't want to do Roth conversions. You want to do Roth conversions in the valley, the low income years is the idea behind that. So here, I really want to get to the math of this, because I think simple math here, and again, we're doing basic algebra, like think 6th grade, basic algebra, no calculus, nothing fancy. You understand this, you are going to be ahead of like 95% of people with understanding Roth conversion. So really quick here, we have a traditional IRA. We want to do a Roth conversion. Let's just say you're at the 12% tax bracket and there's no complex stealth taxes here to increase your marginal tax rate. All marginal tax rate is the actual tax rate you pay on a certain amount of income. And the marginal tax rate can be higher or lower than the stated tax rate because of those tricky stealth taxes. And I say lower because sometimes there's some benefits to increasing your income sometimes. So that's more rare though. So, okay, so we have $10,000 in traditional IRA. We have a 12% tax rate. So 12% of 10,000 is $1,200 in taxes owed. So let's just assume this sample person, Susan, she's 60, Susan's 60. So she's over age 59 and a half. So she just sends the $1,200 to the IRS, and then she puts the remainder into her Roth IRA. So this is her Roth IRA. She started with $0. And again, she gets $8,800 in here because again, she starts with 10,000. She's got to pay $1,200 in taxes, ends up with $8,800. So we're just going to assume in all these simple examples, because the math is a lot easier and simpler, that you pay the taxes from Roth conversions with your retirement accounts. Real world, more complex. So traditional IRA. Okay. Now we talked about this tax rate here. I'm going to introduce investment growth to this. Okay. So again, traditional IRA, we start with $10,000 and we're going to kind of compare. I should actually take a step back. We're going to compare traditional IRA scenario with a Roth IRA, a Roth conversion scenario. So imagine this is like, hey, what happens if I kept my money in my traditional IRA, my $10,000 in my traditional IRA, or I immediately converted it to a Roth IRA, which would be better for me? It's like if you could have a do-over in time, because in real life, you have to make a decision one way or the other. But this is like a hypothetical of I get to do my do-over here and see which one's better. So we have traditional IRA, begin with $10,000. The money doubles, okay? We have the investments, the money doubles. So we end up with $20,000 and we have a withdrawal tax rate of 12%. Well, $20,000 times 12%, we have $2,400 taxes on withdrawal, and we get after-tax amount from our traditional IRA, $17,600. Now, again, what if we had just immediately done a Roth conversion, instead of keeping the money in the traditional IRA? We would have begun our Roth IRA with $8,800 in it, right? Because 12% tax bracket today, means $10,000 times 12%, $1,200, get $8,800 in the Roth IRA. We use the same investments in both of them. We're not changing the investments. Everything else is equal here. Our money doubles. Our ending balance is $17,600. Sounds familiar, right? Again, we follow the Roth IRA withdrawal rules. We get to pull out $17,600. Look at that. The traditional IRA had more growth in it from a dollar perspective, had more growth, and yet it ends up with, we can spend the same amount. We have the same amount of after-tax money available to us, whether we did the traditional IRA or the Roth IRA. The Roth conversion had no benefit here. It didn't hurt us. It didn't help us. No benefit. How the heck is this going on? And that's because it all depends on the conversion tax rate you face today when you do the Roth conversion versus the withdrawal rate you face in the future if you had left the money in the traditional IRA. And so that's why it's really important to think about the tax rates you face today versus the future. You want to do Roth conversions when tax rates are lower today than they will be in the future. Or said another way, you want to do Roth conversions when you're going to have higher tax rates in the future on your IRA money. If the tax rate's equal, no benefit to Roth conversions. Okay. Now we're going to just change the tax rates. Okay. So we have traditional IRA again, $10,000, it doubles. So we get $10,000 of growth and we pull the money out at 12% from the traditional IRA. We pay $2,400 in taxes, have the same withdrawal amount of $17,600. But now what's changed here from the last example to now is in the Roth conversion, we have to convert at a 22% tax rate to get our money into the Roth IRA. So again, we start with $10,000 in the traditional IRA. We convert all of it to a Roth IRA. We have to pay 22% of that in taxes. So we pay $2,200 to the government. And we get $7,800 of money into our Roth IRA. And then we use the same investments. We have the same time period, and our money doubles in the Roth IRA. Same thing as the traditional IRA. Now the ending balance in the Roth IRA, $15,600. Now again, we follow the Roth IRA withdrawal rules, and we take our money out, $15,600. And look at that. The Roth IRA saved us taxes. It saved us $200 in taxes. We only paid $2,200 in this example with the Roth conversion versus $2,400 with the traditional IRA. And yet we are $2,000 poorer in this example. The Roth conversion hurt you by $2,000. What the heck? It's because it all has to do with the tax rate today versus the future. And again, why does the math work out this way? Because remember, that $2,200 that we had to pay to get the money into the Roth IRA and get the tax-free growth, that's $2,200 we didn't have to keep with us and grow and invest with. And that $2,200, guess what? Well, we doubled our money, right? So that $2,200 that we had to give up, if we had doubled it, that would have been an increase of $2,200, which is very close to the difference right here. So my point being is that the math of Roth conversions is just that you need to balance the tax. You need to think about the tax rates. The tax rates are what matter here. Focus on your tax rate today versus the future. Obviously, you have to estimate tax rates in the future. That's difficult. That's complex. And it's really complex to figure out what your tax rate's going to be on your Roth conversion money. That's not easy either, but you got to do it. And if you do it correctly, then you can know, or sorry, you can't know for certain, but you can have a really good idea on if Roth conversions are going to be beneficial or not to you. So now another example, and again, I'm just going to increase the growth because what happens if you have tremendous growth? Doesn't that help the Roth IRA? Well, not necessarily. Same thing, traditional IRA, we get, we quadruple our money, 4 times our money, $50,000, withdrawal tax rate of 12%. We have to pay $6,000 in taxes, $44,000 after tax. If we had taken that $10,000, converted it at 22%, started out with $7,800 in our Roth IRA. Again, we quadruple it. Is that? Yeah, that's quadrupling it. We got $31,200 of growth. So the same investments in here, same time frame. Our ending balance $39,000. Withdrawal rate $39,000. We lost $5,000 on the Roth conversion here. So again, tax rates. It's all about the tax rates. I'm probably beating a dead horse here. This is the opposite way now. This is where Roth conversions are going to be beneficial for us because we know this $10,000 beginning, double our money. 22% tax rate, have to pay taxes, left with $15,600. Now, alternatively, we could take that $10,000, immediately do a Roth conversion at 12%, and begin our Roth IRA with $8,800 in the Roth IRA, $0 in the traditional IRA. We double our money, same investment, same time frame, and we get $17,600, and now it was beneficial. So again, really key here, if you're thinking about how can I benefit from Roth conversions, all about the tax rate today versus the future. Now, there's a lot of factors that affect these tax rates, right? And that's a whole, that's basically why I started this Facebook group, is that there's so much going into determining current tax rates versus future tax rates, but you need to do this analysis. If you don't do this analysis, if you can't make an educated guess, well, really, you should know how much what your tax rate is today. You can figure that out for sure, because we know what the tax code is today. You can calculate your income, figure out how much the Roth conversion will be taxed. You need to make an educated guess on the future. But if you can't do those two things, then really you're just throwing darts at the board and hope the Roth conversion works for you. So that's that. Let's see. Ooh, oh. Man, this thing is sensitive. What am I doing here? Oh yeah, and then I'm just using the same example before, except I'm just adding on growth here, and we can see again, because the tax rates changed, now the Roth conversion is beneficial. So you understand this math, you are well on your way to helping yourself reduce your taxes, be tax efficient in retirement, and hopefully, getting a little bit more enjoyment out of your money because you're sending less to Uncle Sam and keeping more for yourself to spend. So I hope that was helpful. Bring on the questions. I see we've got a couple here. I've got future inheritance also comes into play with tax bracket increasing in future. Just saying. Yeah, absolutely. So this is a great point. I said, hey, it matters about your tax rate today versus the future if you want to benefit from it, but maybe you're not so concerned about you benefiting from it. Maybe a spouse you're concerned about, especially there's the widower tax penalty where one spouse dies, the remaining spouse, basically their tax rates get cut in half. So their taxes almost double on the same amount of income. But generally, their spending for a spouse doesn't decrease in half. So your tax doubles and it would equal out if your spending decreased 50%, but usually that doesn't happen. Usually your spending is still going to be more. So spouses can get taxed more, be subject to higher tax rates. Roth conversions can help protect that. And what they're saying here is, well, what if I've got enough money and I'm doing this and it's great if it benefits me, but I also care about my kids. Well, yeah, again, you can use your kids' future estimated tax rates here for the future tax rate. That gets even more complicated to estimate because then you have to figure out what your kids' tax rate's going to be when you die, which could be decades from now. That's tough to do. And of course, how much money you leave them can influence the taxation of the IRA. Inherited IRAs, again, the rules around these have changed a lot in the last couple of years, and they're not for non-spouse beneficiary. The rules have gotten more restrictive and less favorable for non-spousal beneficiaries like your children. So now your kids in general, they got to take the money out within 10 years. And if you had already begun starting RMDs, then your children generally going to have to take RMDs out every year. And then at the end of the 10 years, take the remainder out. So if you leave a large pre-tax IRA account to your children, they could be paying a lot of taxes. Now, of course, this is first world problems, right? Because if you pay a lot of taxes, you get a lot of money. So I think that's a fine way to look at it. Like, hey, I'm giving my kids a lot of money. Okay, you got to pay taxes. Like, tough, buddy. Like you just got a bunch of money. I don't feel bad for you. On the other hand, people are like, well, if I can be efficient and help my kids save taxes, that's great. But again, the same concept applies. You can go overboard and be like, I don't want my kids to have to pay any taxes. Well, like they could end up with less money. They might be better off just having more money and paying the taxes on that money than getting it all tax-free in a Roth IRA, because Roth IRAs, you got to take all the money out in 10 years, inherited Roth IRAs, I should say. You can still, it's all tax-free to your children, but the same kind of numbers here apply. So love the comment. Inheritance is taxable. Well, okay. So not inherit money you receive from someone. It depends on the account type the money's in, the type of money. So you inherit a Roth IRA. It's all tax-free for the Roth IRA, as long as the Roth IRA withdrawal rules are followed, which I believe, I know inherited Roth IRAs have special rules, and I think, I can't remember, so don't quote me on this. I think they waived you can be under age 59 and a half and take money out of an inherited Roth IRA tax-free. I'm pretty sure, because they want you to take it out. So, but if you inherited a pre-tax IRA, traditional IRA, then the money out of that, when you take it out, is going to be taxable. So, or if it's a taxable account, a non-retirement account, think joint account or individual account, brokerage account. Generally, if you have, well, it depends on the assets, but they get stepped up in basis. And so those can be taken out tax-free, just like a home can be sold tax-free. So as long as you sell it like right then and there, once someone else owns it, then they'll get taxed on going forward. But yeah, so it just depends on what assets you inherit. And then there are inheritance taxes in some states. I think maybe like Kentucky has an inheritance tax. It's really rare. There's only a couple of states who have inheritance taxes, which means that estate taxes, the person who passes away, that money is subject to taxes from their estate. But inheritance taxes are saying, hey, the people who receive the money their inheritance is taxed. So it's kind of like two sides of the same coin, but it's a little bit different. So that's a fun thing to keep in mind. IRA distributions. Yeah, IRA distributions, withdrawals. There are some technical differences, but oh yeah, you're answering their question. Inheritance is taxable. Yeah, exactly. IRA distributions for pre-tax. Yep, correct, Debbie. Thanks for answering the question for me. Does it make sense to leave most of the money in the 401k and do in-service withdrawal 80K per year to roll over IRA to Roth IRA in order to avoid pro rata rule for Roth conversion ladder? Oof. All right, let me take a little bit of water on this one. Well, it can make sense absolutely if you have after-tax money in your IRA. So what this person is asking is, hey, Larry mentioned the pro rata rule. That's saying that you have to aggregate all of your IRA accounts and kind of view them as one when you do a Roth conversion or take money out of your IRA. So this can be painful if you have after-tax money and an IRA. Like, let's say you do a Roth conversion from this IRA, and you've only put after-tax IRA contributions in there. It's $10,000 of after-tax money in the IRA, but you have another IRA that has $1 million in it. So you have $1,010,000 total in your IRAs. Well, this IRA that has $10,000 in it, that's all after tax. You do a Roth conversion with it, and you would expect, well, excuse me, hey, I just have after-tax money in this, so it's going to be a tax-free Roth conversion because I can't get taxed twice on this money. So I'll just be able to put this money tax-free in the Roth IRA. Not the case. The pro rata rule goes, IRS says, hey, let's look at all your IRAs together, buddy, and say, okay, we're going to look at the $1 million of pre-tax money and the $10,000 of after-tax and say that essentially, roughly 1% of your money is after tax. So even though you're taking $10,000 from your after-tax IRA, only 1% of it is going to be after-tax money and 99% of it is going to be pre-tax money. We're going to magically transfer that after-tax money into your other IRA account. It's a crazy rule, but it's a real thing. So a way to get around that is to roll money, all your pre-tax money, your IRA money that's pre-tax into 401ks. You can segregate pre-tax and after-tax money when you roll it into a 401k. And then you got to keep it there for the whole year. Because if you roll it back, like if you do a Roth conversion with only after-tax money because you did the 401k rollover, and then before the end of the year, you just roll the money back into an IRA, they look at it at the end of the year. So that's not going to be good for you. You want to wait until the next year to do any rollovers. So if you have after-tax money in your IRAs, then you can, it makes sense to leave, most of your pre-tax money in the 401k, do an in-service withdrawal to a rollover to a Roth IRA, to avoid the pro rata rule. But really that would be if you had after-tax money in your, I think I see what you're saying. So if you have after-tax money in your 401k, so if you have after-tax money in your 401k, you're allowed to split it out and from your 401k and just put it directly into a Roth IRA. In fact, and just like it's a tax-free Roth conversion. When you do that, there are some rules around that, so you want to be careful, but it's a possibility. But yeah, and then otherwise, if you have after-tax money in IRAs, you can leave money in the 401k, and if you need some money to live on, that 80K per year or something, you can take the money out of the 401k, pay the 80K, but then do the tax-free Roth conversion, but then once you have after-tax IRA money, it's really only happened for a year, and then you've got it out, and so then you can keep the money in your 401k or IRA. That's just like 401k versus IRA. That just becomes like do you want to keep money in your 401k or IRA decision. So the pro rata rule probably shouldn't affect you too much. For Roth conversion ladder. So I think I'm getting to the point of your question. Hopefully that was helpful. Would you discuss how using conservative growth assumptions for Roth assets would make Roth conversions more likely to be beneficial. Sure. So there are, when you do the Roth conversion calculations, especially when you use software to do Roth conversion calculations, it is very, very sensitive to the investment growth rate you assume. And the higher the investment growth rate you assume, the more benefit the software is going to tell you the Roth conversion has. Well, as we all know, past performance is no indicator of future results. And so if you assume, hey, I'm going to earn an 8% rate of return on my portfolio over the next 30 years, and the software goes, great, you should be doing a lot of Roth conversions because based on that rate of return, this is going to be tremendously beneficial. And then, well, it turns out you only get a 6% rate of return. Well, maybe you just did too much Roth conversions. Maybe, like your first 50% of Roth conversions was good, but the second 50%, maybe you shouldn't have done. You over converted, you converted too much. And so maybe you still overall got benefits from your Roth conversions, but you could have been even more beneficial if you had lessened the amount of Roth conversions you do. And sometimes it can be the difference of like, hey, you should have done any Roth conversions at all. So you have to be really, really careful of the inputs when you do Roth conversion calculations, especially if you're relying on software to do the calculations for you, and be conservative in it, just because, again, your tax situation going forward is what it is. If you do nothing, if you don't do any Roth conversions, it is what it is. Roth conversions can help or harm you. So if you have really aggressive growth rate investment assumptions, or what have you, and they don't come to fruition, and you do Roth conversions based on these aggressive assumptions because the software tells you to do them, then you could have increased your lifetime tax burden and reduced your after-tax wealth, which again is what we care about. You basically reduce your wealth, which is what we're going after at the end of the day here. That's the goal. Love that comment, David. Thanks for it. When the future tax rate is unknown, is there a benefit to go ahead and do some conversions besides giving to the kids? Well, so future tax rates are always unknown, right? I think it's just a balance of like how comfortable you feel in guessing at a range of tax rates. And that's going to depend a lot on your individual situation too. Like you could say, if you have low income in retirement, it's a possibility that your income could be taxed a little bit more in the future. And if you have really high income in retirement, there's a possibility that your income could be taxed more in the future as well, or maybe less. Just kind of depends on what your view is of the future. And so we're always dealing with this unknown is just what I'm going to say to begin with. And then is there a benefit to go ahead and do some conversions besides giving to the kids? And that's where I think it really depends on what your tax rate is today. That you're good. I like how you're thinking about the future taxes, but what's your tax rate today? And again, like I'll give you an example. Some people don't fill up their standard deduction. Their income is lower than their standard deduction. Okay. So what that means is that they can do a Roth conversion of $10,000 and face a tax rate of 0. This is for some people. It's a small percentage of people, but some people, and I've seen it. So they can do a Roth conversion at 0%. Well, if you can do a Roth conversion at 0%, there is no downside to not doing it, because if you're basically locking in that 0% rate. So even if let's say your traditional IRA would have been withdrawn at 0%, it would have been a tie. But ties almost always go to Roth conversions because Roth IRAs do not have RMDs for them. So in the real world, like in my example, I'm not looking at RMDs here, but in the real world, there are required minimum distributions. And of course, there's paying the taxes with outside accounts. All that stuff kind of tilts the odds to Roth conversion. So tie goes to the Roth conversion the vast majority of the time. But I'd say, like, if you don't feel comfortable assuming a growth rate and you're not going to calculate how your Roth conversion would be taxed today, best to leave it alone than, taking a risk and making your situation worse or better. You really got to run the numbers for it. But I would say another thing is that if you're married, you also want to think about what happens when there's just one of you, that surviving spouse. It can be nice to do Roth conversions when you're married because your income is double. And then if something happens and there's only one of you, then the surviving spouse won't be hit as hard by the widower tax penalty. But again, Roth conversions, it's really easy to do too much of a good thing. Less is more. Be conservative with the assumptions and calculations on it. So I'm always going to not say like, hey, if you're like, should you do Roth conversions? I don't know. Like maybe just go ahead and try a little. Like, no, probably best to just not do them. Then if you're just like, maybe I'll do a little just because that's not, I wouldn't recommend that. If future tax rate is unknown, we might still go ahead and convert a portion to benefit from a tax-free bucket. The question is how much to convert. Yes. And right. I mean, I again, you could think like, hey, I'm diversifying, I'm diversifying my bucket so that I might not be optimizing my situation, but if I don't know where tax rates are going to go in the future, well, if they increase in the future, then if I did a Roth conversion, I would benefit, right? Tax rates go up and I got to do a Roth conversion. You can almost think of Roth conversions as locking in your tax rate, right? That's another way I like to describe it. You're locking in your tax rate. So if you can lock in a low tax rate, that's good. But if you lock in a high tax rate, that's bad, right? And high and low is just relative to what you would pay in the future. So, but if we don't know what this future tax rate is, well, we do a little bit of Roth conversion. We've got some diversification. So if tax rates are higher in the future, we benefited. And if they aren't, then we were made a little worse off. But like we're diversified. We're like any scenario, we didn't convert everything. So we still left money in the traditional IRA. I probably should have stressed more that like, I'm definitely a fan of less is more with Roth conversions. Don't convert the whole farm. That almost never, especially in 1 year, that almost never makes sense. Yeah, I see where people are coming from with the tax diversification standpoint. I guess, hey, financial planner here, like I'd like to optimize and like, let's be strategic about it. But I see where people are coming from. I don't mind it a little bit if that's what you're thinking of. But again, I'd say less is more there. And you still want to know what tax rates you're facing today. If you can't calculate what tax rates you're going to face on your Roth conversion by doing it today, be really careful because you can easily get hit with IRMA, capital gains tax. I mean, it's easy to think you're paying 12% tax at Roth conversions and really be paying like 27%, 35%. You can, if you're really unlucky, you can do a Roth conversion and have to pay income tax on the Roth conversion, cause capital gains taxation to increase, and cause Social Security taxation to increase and get hit with a triple whammy, the triple tax. Really rare, but it can still be possible. Lose ACA premium. So just be careful with it. And, I actually realized that I had like one or two more slides here that I want to do. Margin of safety is just, hey, make sure you do these calculations and don't get too aggressive with your assumptions. Less is more with Roth conversions. Don't do everything at once. Generally, if you're on the border of like, hey, do I convert to the 24% or 22% tax bracket? Hey, less is more here. Like the benefit, not every Roth conversion dollar is equal in the benefits it's going to provide you. The larger the tax rate difference, the more that Roth conversion provides. So like if you're going to fill up your 12%, 22, and 24%, you're going to get the most benefit from filling up your 12% bracket. And then you're going to get, not as much benefit from filling up your 22% bracket. You're going to get the least amount of benefit from filling up the 24% bracket, dollar per dollar. Now there's a lot more dollars in the 24% bracket. So the math can be a little more complicated than that, but still in general. And then stealth taxes, watch out for those. Remember, Roth conversions are not as simple as saying, oh, I'm in the 12% bracket today. I think I'll be in the 15% bracket in the future. Got to consider those stealth taxes when doing them. And that is all I got for you guys. Let me check YouTube. Aw, David, thank you for commenting in YouTube. I appreciate that. I got my first ever YouTube comment on a live stream. Appreciate you, man. And let's see. I think Ed Slott is a proponent of convert as much as you can, never pay tax again. I really respect Ed. He is a wealth of knowledge. He knows more about the tax. He's probably forgotten more about the tax code than I've ever learned. I think that he probably, is really jazzed, but I've seen him give advisor presentations and he's much more measured and he talks about some of the stuff I'm talking about. So I don't know where you heard that. You could be right. I don't know Ed personally, so I haven't ever heard him say like his personal opinion on it. But I think he's usually like pretty measured about stuff. To be fair to Ed, I guess I'm an Ed fan. I'll admit it. I'm a big Ed Slott guy. So there you go. To determine one's future tax rate, one needs to estimate his future RMD, i.e. forced income. If one has a large expected RMD, aka required minimum distribution, they will push him to higher brackets than IRMA. In this case, it's even less likely for a Roth conversion to hurt you. Might be better to convert now, move it in 24% and incur IRMA now. Absolutely. And I think what's really key in projecting your future tax rates is to run a retirement income projection and project out your income exactly what you're saying. I basically agree with you 100% that it's all situation dependent. It can be really good to go. I mean, heck, there are many people who should be filling up everything before the 37%, before the top income tax rate. And there's even a case to be made for some people to literally convert, through the roof. They can't, because they think they're going to be taxed more in the future. It's so situation dependent, specific for everyone. But I really like this comment. And I definitely think you make some good points that, yeah, I mean, you got to think about your future income, how it's going to change in the future. RMDs can crush you. I will say, though, it can be really difficult to, like, for example, let's say you're 65. Okay. You just retired, 65, thinking about doing some Roth conversions, and you're 65 now, your RMD start age is 75. So that's 10 years in the future. Well, Medicare has some funding issues as well as Social Security. And stuff's probably going to change between now and then. Now, Medicare is not nearly as bad as Social Security. But chances are Medicare is going to change. And so IRMA, like projecting IRMA 10 years in the future, you need to know future inflation. It's difficult to project. So I would stress that, like, if your projection show, oh man, I'm like $1,000 over the IRMA limit from 10 years in the future now to 20 years in the future. Like, hey, there's a lot of wiggle room here. Let's be a little humble. Like, we probably can't accurately project our income out like to the next thousands. But I think your overall point, like, I agree with it 100%. Love the comment. And I think it's really helpful for a lot of people that you gotta think about RMDs in the future. So thank you for bringing that up for everyone. Thank you all for the session, man. We went to a little bit of a marathon here. We got 1 hour and 18 minutes. Look at that. So I appreciate you all. You all have a good night. And again, YouTube channel, if you haven't checked it out, go check me out. 2-minute retirement planning. Going to do a lot of shorter stuff on the live stream. And next week we are doing Ask Me Anything. I've got no presentation. You guys show up and just start asking me questions. I'll answer everything to the best of my ability. Obviously, I won't be able to answer everyone's questions. I'm sure you'll throw me for a loop, but yeah, go ahead. Challenge yourself, stump me, whatever questions you got, I'll be here to answer. Appreciate all of you guys, but the thanks, and I'll see you all next week. Until then, happy retiring.